The start of a new quarter means it is soon to be earnings time. Beginning next week, we will learn how companies did over the past 3 months and what their chiefs say about business for the rest of the year. Joining us now to discuss is Paul Schatz. He's president of Heritage Capital. Mr. Schatz, welcome. Good to have you with us. A lot of the investment folks that we've been talking to say that now that the Fed has signaled that it may dial back on stimulus, that the focus is going to shift more and more to business fundamentals. What companies are able to grow profits and revenues and which are not. Do you agree with that?
The answer is yes, but I think it's a short-term focus, Tyler. First of all, there's really a vacuum of news right now, so earnings are going to start next week, and we'll be really focused on them until we're not, and that's probably only a couple of weeks at best.
All right, so what can we expect out of this earnings season? What will CEOs be telling us about their earnings and their revenues?
I think it's really more of the same. People are craving for top-line growth. They're not getting it. They're making the numbers in the bottom line, but the top-line growth's not there. And I think that has somewhat of a that's been a longer-term drag on the market. I think it remains a long-term drag. Equities are pretty stretched, and I think you'd really need earnings to blow out to the upside to get any kind of catalyst here to get us past maybe 16,000 on the Dow.
And you don't see that blowout of earnings coming. The S&P right now is at about 1,600 and change or thereabouts. It was a heck of a good first half. Where do you think this barometer is going to end the year? Do you think we have more gains ahead, or are the best days behind?
So in January, our forecast was that this year was going to be tremendously front-loaded, much like 1987 was. And I still feel the same way. I think all the easy gains are made. I think it's at least 50-50 that the highs are in for the year. I could see a poke above to make a nominal new high, but I wouldn't put all my eggs in the equity basket right now. I think you're going to have an opportunity to buy equities 10 to 20% lower over the next 3 to 6 months.
All right, so where would you put your eggs right now? What baskets do you see opportunities for investors?
So for equity investors, I think you've got to play it close to the vest. Just because the market's going to go on sale, and I've heard other folks talk about we're now back to single stock risk and a rising tides not lifting all ships. I agree with that. I think whatever rallies come from here for the next few months are going to be very narrow, and I don't think you're going to throw a dart at an index, and that index is going to lead the way. So I think you're selective. I'm still bullish on financials, and I'm still bullish on biotech, and I think even healthcare could get a little bit here. But the key is when the market corrects, which I think it will over the next couple of months, they're all going to get hit. It just depends upon to what degree. On the flip side, bonds have been hit pretty hard, and I think there is some relative value in the bond market. So certainly investment grade, the higher quality bonds I'd be looking at right now, as well as floating rate.
So, another way to put you're going to have an opportunity to buy stocks at 10 to 20% lower prices is that you're going to lose 10 to 20% of your money if you're in stocks over the next few months. Let's talk a little bit more about bonds. You think that they're bottoming or what?
So I think it depends upon what time frame you look at. Bonds had a really tough second quarter. They had a very tough June. And let's say these 30-plus year bull market in bonds ended this year. It's not going to be a straight line move from 2% in the 10-year to 8% in the 10-year. It'll be a sawtooth move. So we were stretched already. The bond market got hit pretty hard. I think the next decent move in bonds, the bond market probably rallies, which means rates come down a little bit. And I think that's where you probably are for the third quarter. Bonds should be okay this quarter. And I think for the more aggressive, you could tiptoe into gold and the metals.
All right, Paul, thank you very much for your look ahead to the second half of this year. Paul Schatz is president of Heritage Capital.